You're listening to Real Investor Radio with Craig Fuhr and Jack Bevere, where we cover advanced real estate investing topics to help you stay ahead of the curve in your real estate investing business. Hey, welcome back, everyone, to Real Investor Radio. I'm Craig Fuhr, joined again by my good friend, Jack Bevere. Jack, I'm so excited for today. I am rested, relaxed, and ready. Did not get our haircut, but our guest did. And so without further ado, let's not do any pre-stories today, Jack. Let's just jump in and introduce Danny and jump into the conversation.
Yes, I'm super excited to have Danny Kattan on the show with us today. Danny's been a great friend. We met early in the emergence of the institutional side of the industry. We started meeting him at conferences probably 10, 11 years ago now. 2012. 12 years ago now. Wow, crazy. So Danny and his partners own the PIA Group, which PIA residential, and they were aggregating single-family houses in the Miami market very early. We met him at some conferences and became immediate friends because we were on very much the same path in terms of aggregating and interacting with the hedge funds and borrowing money and trying to see where the world was going. And they were getting phenomenal deals on houses in Miami. We were getting phenomenal deals on buying houses in Atlanta and in Baltimore as well. And so we've really kept in touch over the years and are good friends. And Danny had the opportunity to exit. He and his partners exited their single family rental portfolio, started investing in multifamily, didn't leave residential, but just pivoted from single family to multifamily. And then I've really just have tremendous respect for Danny as an incredibly intelligent operator who's willing to roll his sleeves up, but also is always thinking where the world's going to be 10 years from now. He's, the guy who's always thinking about where the hockey puck's going, and that has served him very well. And he's got not only the multifamily syndication company that he and his partners put together 6 years ago now, as well as a new venture called Sell to Rent, which we're very excited about, and I think is, frankly, an idea that time is coming, is now. And so we got lots to dig in with Danny, and he's always a joy to talk to. So Danny, welcome. Really appreciate you joining us today.
Thank you, Jack. Thank you, Craig. Yes, as Jack mentioned, we met in 2012, what I call when the single family asset class started. I tell people that we were in the room when people decided that this was going to be an asset class and not a trade. Remember the conversations, and we became really good friends with him and Jack and Fred, his partner. It was amazing because we shared the same principles, the same values. We see kind of the same life through the same lenses. We kind of opened the kimono, exchange ideas, and I think this sort of openness was part of what led to create the IRR, right? Of let's collaborate. And I think that you go farther when you go with people than you do it alone. Having said that, just a little bit on my background, we started buying houses. By the way, I'm from Colombia, South America. That's because it's the incredible accent that I have. I had better English, but then I lived in Miami, which became worse. Anyway, so we started buying houses in 2008, one at a time. Initially, we bought the house for an investor, and we sort of turnkey it for them. After the third house, we had to create a property management company. Then we realized we had to create software, and then a maintenance company, a construction company, and warehouses. And before you know it, we had a whole vertically integrated platform, much like Jack and Fred. And so we identified with the mutual pains of, growing that. In 2012, a industrialist from Latin America came and gave us about $60 million, which we helped grow our portfolio. And then about 2018, we ended up selling our portfolio to a company called Cerberus out of New York, about 400 houses, 400 small multifamilies that we had at the time. We sold about 200, and then we pivoted to large multifamily. And why we did that people like, aren't you like, don't you regret it that you sold in 2018? I'm like, in hindsight, yes. But the reality, and by the way, just to give you an idea, we sold for $250,000 per unit, per single family unit, in what people thought was a crazy price.
Mm-hmm.
I mean, I got a phone call from I think he's a CEO right now of a very large fund, asking me if I had, some type of pictures or intelligence on the people from, Fresh Key because they paid so much, right? So it wasn't a cheap price. But the reason we sold is because we always thought that in residential, or at least real estate needs to be grounded in solid principles. And the way I explain it is the cow is worth the milk it gives.
Mm-hmm.
Otherwise, it's a pet. Pets are very expensive. And so that's the difference between having a asset. You never heard that one, Craig? It's copyrighted, by the way.
I've already written it down, and I'll be using it later.
So we were called the cow guys in Florida because all our entities were named cows. Like it was green cow, purple cow, red cow, Cuban cow, Mexican cow. Literally, our company was Green Cow Holdings. We always saw. You never knew this, Jack?
I didn't know that.
Danny, can I stop you for 1 second and say that very few people know that my favorite animal on earth is the cow. Not because they're so delicious, but because they're just so goddamn cute. And so I find that, absolute favorite animal on earth. So keep going. I apologize.
Listen, there's countries, different countries where.
Yes, of course.
Right. So again, real estate is grounded, regardless of the asset class. Anything, companies, Warren Buffett made his money buying value because, they analyze things as cash flow, right? And so at that moment, when we started buying in 2008 and 2009, which by the way is a shitstorm, people thought that we were crazy. We called people, and probably you, Jack, that had a lot of money in the bank. It's like, listen, we're buying this house that it was worth $200,000. We're buying it for $70,000, putting $30,000 in. The government, the U.S. government's going to pay you Section 8 money that is going to be a 10, 12% cap rate.
Mm-hmm.
Oh, no, it's too risky. The market might double. So between 2008 to 2012, the market was scared, right? And for me, there was no reason to be scared because you were buying cash flow. Most important, you were buying below replacement cost, which is, by the way, the number one thing that you have to look for in addition to cash flow. And equally important, you were buying below economic value. So let's define economic value, right? There's a metric out there where it's cheaper to rent or to buy. So think about it. You don't have to be a macroeconomist or microeconomist to understand this. Right. And by the way, just on a part, the other day, my very smart daughter, Eva, 16 years old, asked me, what does an economist do? And I'm like, try to explain. And she, by herself, she's like, oh, it's like a meteorologist. I have no idea.
Yeah.
Okay.
A bullshit artist.
Yes. Anyway, so if you think about it from the layman's perspective, if it's cheaper to pay a mortgage than to pay rent, and you have the ability to buy a house, then you will buy a house.
Mm-hmm.
Right? If it's cheaper to rent than to pay a mortgage, then you will not buy a house. From 2009 to about 2008, 17, it was cheaper to buy a house than to pay rent. So if you took a rent payment, let's call it $2,000, and you converted it into a mortgage payment, and you could afford, let's say, $250,000 homes, and the homes were trading at $200,000, then logic will have it that house eventually will settle, we'll buy it for $250,000. That's what I call the economic value. So these three legs of real estate, they're already redlining in 2017. We sold for, what we thought it was a really good price, and cap rates of 5.25%, 5.5% in 2018. Cost of capital was way more than that.
Yeah.
Okay. We sold for $250,000 per unit. By the way, sold one check, occupied, which means that you didn't have to retail it. So that was the equivalent of about selling for another 10% more. So it's $275. By then, you can actually build a brand new house in the places where we're buying houses for about 250.
Yeah. So
Right?
you'd hit both of those equilibrium where you were selling at a price where the
There
market
were red
should get
lines,
to,
and it was
and a mark
and,
to
it,
market on replacement
and the
cost.
reason we sold is because the rents did not increase as much as the prices, right? So it was eventually it was cheaper to rent than to buy.
Mm-hmm.
Okay.
Yeah, that was our experience and very much the same logic we used to
Right.
sell in when we sold our portfolio in Atlanta. And what we all didn't know was that we were going to see some inflationary times and that rents were going to continue to increase. And
we'll talk about inflation later, Jack. But this is so. I'm from Colombia, like Latin America. Inflation is a daily basis thing. I mean, you guys had inflation, forgot about it, blame it on the oil wars, and then you had inflation again, then blame it on that government, and now we're back to inflation. And you can blame it on whatever it is. I think it's here to stay. But,
so why the pivot into multifamily? Why do you still like residential real estate? And you mentioned when we were chatting before we got on that you thought now is a good time to be buying in multifamily.
Sure. So let me walk you through that logic. So we ended up selling, and then now we have some good money, right? And we also thought that it's 2018. It's already been 10 years. There is a recession that is going to come, right? It's fair, right? It's recessions in the cycle. This whole thing of there's a book way back in the early 90s written by Ravi Batra called, I forgot the name of it, The Great Recessions of the 90s. And he actually argues that economic cycles come in 7-year periods. And that's where the 7 cows in the Bible come, the 7 fat cows and 7 skinny cows, right? So it's already been 10 years of growth. You have to.
We're overdue. Right?
Yeah. So now we're sitting down with some money and we said, okay, there's a recession coming. When we were buying houses, I literally saw 6,000 homes to buy 400. I walked into, I drove. And one of the things that actually impressed me a lot during, the early times in the Great Financial Crisis is that you had shopping centers that were empty, warehouses that were empty, and, all this impact that, a down economy has on real estate. Yet when we had single family homes, we could always rent it. It wasn't a question if it was rented. It was going to be $1,500 or $1,400. Right. As long as you were not in Detroit at the time, and we'll call it the Detroit effect later, right? And you're a city where people are migrating and it's growing and so forth, you're always going to be able to rent it. Okay. So we said, you know what, there is this thing, recession coming. And that's when I also started thinking about there's technology that will affect real estate. Right. So simple, right? I mean, nobody's going to go buy a Barnes & Noble because you have Amazon, right? So if you have a triple net Barnes & Noble, you have to think about what Amazon's going to do. I started talking about that, Jack, as you know, started writing about it, saying, you know what, there's a lot of technology that will affect real estate. You have to understand what technology which affect each real estate. And so now we will probably not go buy a gas station, not that gas stations will disappear, but definitely will be different in 5 years from now, 10 years from now. So we
because
said,
because of self-driving cars and EV and all those effects. Yeah.
Yeah. What is the constant? The constant is people need a place to sleep. And the Maslow theory of, priorities.
Hierarchy of needs. Yeah.
Yeah. There you go. You said nicer, right? Food is you got air and water. Food is number one, right? But my saying is that right now, food is not important because there's food everywhere. You have food banks. You can really go anywhere. And I'm from Latin America, and I can tell you that, aside from political conflicts, people in the world, they're not dying of hunger. They might die of malnutrition, but they do die for exposure of the elements or the insecurity of not having a home or living in the streets, right? And so what we experienced in 2009, 10, 11 is that people were clinging to the possibility to live underneath a shelter. So, if they couldn't pay, then 2 families got together and, they basically, in a house that was a 4-bedroom, there were 3 families living together, right? Because that it's very important. And so we believe in our heart of hearts, and I will challenge people to question it, that right now shelter is the number one priority for a human being.
Yeah,
right?
even when COVID hit, I missed this. I screwed this up. I was like, hey, when COVID hit, it's really poorly affecting the economy, and so houses are going to become in distress, and people are going to need money. And the opposite happened, right?
Yes.
People got scared, and so they shut the doors and they closed the doors and they made their mortgage payments and they made their rent payments, because the last place you wanted to be was having to bunk up with somebody or out on the street. And so
true.
that physical need for shelter in when people are afraid was like COVID really drove that home for me. And I missed that, right? I was bailing on contracts because I thought we were going to buy houses cheaper a year later. Couldn't have been more wrong, right?
Yeah, well, I think everybody missed COVID. Sometimes we miss it, right? Being left in the home with the family, but we missed the opportunities that COVID brought, right? So what we decided in 2018 is that we're gonna keep doing what we're doing on the residential side, because on the residential side, the rents are very resilient.
Sticky.
And if you really think about it, the person who I think gets clear indication the best way to make money is Warren Buffett. First rule, don't lose any money. Second rule, look at rule number 1, right? And yes, right, you can hit home runs and once in a while, but we're in the business of asset preservation. Me and my partners are in the business of not losing anybody any money, period, right? Investor money is sacred. We don't take risks with that. So we created a very defensive box in which people can invest money with us. And what we said is we're going to get out of South Florida because it's already frothy, and we're going to go to secondary and tertiary markets that behave very well in a downturn, okay, that are in the Southeast, where people are migrating and jobs are being created, and then you don't have a specific concentration on an industry, which is, so avoid the Detroit effect. So funny enough, we ended up being in, we looked at a deal in Pensacola for a single family portfolio that was there. And so we became very familiar with Pensacola. So when we started looking at properties in a multifamily showed up in Pensacola, we thought it was a great opportunity, because Pensacola is it's a military market where people migrate to the Redneck Riviera. You have vacation people, you have retirees, and then you have all this economy based on the military. So people retire there because they have a good VA system, a hospital, right? And people, companies put in their call centers and factories because there's people migrating there. Of course, you got Florida, which is a very pro-business state. We bought that building in Pensacola. That was in 2019. Always using Freddie or Fannie debt, okay, and make a note out of it, because I like to talk about what I call the government put, okay, and always with 10-year fixed. So right now there's a lot of people who are in a lot of trouble because they decided that real estate was basically a gambling machine where you gamble with the bond, right? We initially said real estate is, we're buying the real estate. You're fixing the debt for 10 years and you take the risk out of the table.
What's the, explain to everybody what the government put, explain that.
Okay. So one of the issues that happen in real estate when it hits the fan, right, is that you might not be able to pay your mortgage. Okay. So if your lender is a bank, or if your lender, let's say it's a CMBS loan, private guy from New York, whatever it is, that loan will get sold to eventually somebody who's a vulture. It's going to come for your blood. Okay. The government, Freddie and Fannie, keeps their loans. They control their loans. They securitize them, but they control their loans. So when we started looking at this, we had, deal with Freddie and Fannie before in a small multifamily. We realized that there's an embedded sort of protection when you borrow from the government, which is the government doesn't want to go take the property away from you.
Yeah, right.
Unless you're cheating, right? And you're stealing. So the cool thing about this is that, when we were buying in 2019 and we designed our defensive buy box, we said, you know what, we will only buy with Freddie Fannie loans, long-term debt, fixed rates, so forth and so on. Okay? COVID happens. couple of months after COVID happens, we get a call from our servicer. It says, guys, this is our servicer. Don't worry about it if you cannot pay any mortgages, because of people are paying the rent.
We know it's
Don't
hard.
evict them, so forth and so on. So the government is telling you, don't worry about it. We're not going to come after you.
Yeah.
And that for me, it's hugely important, because one thing that we cannot underwrite to is that, black swan event that you might be left high and dry. Now, the cool thing about it is that this is a military economy. Most of the people that were in our property were either military or affected by the military. I mean, the cool thing about a property is that you can see the Blue Angels, fly up top, because it's next to the Pensacola Naval Air Station. So, yeah, theory work, checked. Okay. Then COVID hits, we're going to go out and buy more properties. So now it's the time to buy. There's blood in the street. Everybody's scared. And we realized that every time that everybody's scared, you have to go buy. It took us a while to convince people to help, to go into and buy another multifamily. We bought another multifamily in Jacksonville. Jacksonville, again, military market, hospital, banking, port.
Yep.
Strong economy.
Heavy net migration.
Florida migration, so forth and so on, right?
Mm-hmm.
Then we started analyzing a lot of things, and then you start seeing sort of the dumb money come out with the low interest rates.
Mm-hmm.
And so 2021, we had to see a lot of properties. We wanted to buy one. We bought another one in Savannah, Georgia. In Savannah, basically, when I went to Savannah the first time, I'm like, idiot. It should have been there like 5 years before. Huge post-Panamax port, tourism, education, right? It's a city that will just work because it's the vein for where all the sort of containers go to Atlanta, right? And so it's always going to be there. I mean, Savannah is a little town with a huge port, right? It has intrinsic demand. 2022 rolled over, and by the way, every property we're buying with an SPV, GPLP structure, we sort of brought in investors that we knew, and then they brought in investors that they know, and after the single family platform, we kind of became an open platform. Initially with the single family, we're dealing only with one wealthy individual, and then we started taking on some money, out of which you guys, Fred and Jack are investors. And then in 2022, we bought one in Fayetteville, North Carolina. Fayetteville is Fort Bragg, and it's one of the largest military bases in the United States, if not the world, right? So again, military economy, very resilient. Okay. In 2022, then we saw another property in Birmingham. And by then, our investors, which in most cases are very sophisticated family offices, ultra high net individuals, a couple mom and pops, some bankers, Wall Street people, they started saying, listen, every property you put in front of us, we buy. I got 4 out of 4. It looks like a fund. Why don't you create a fund? Mm-hmm. And so we got in the idea of creating a fund. A fund by default is less risk to an investor because you're investing in several properties at one, has less fees. Okay. And so we created the fund. We bought the fund. We bought the Birmingham property with the fund. Most of the money came from the fund. And then, the sidecar of some of the large investors that still invest with us that, they don't invest in funds because they're not allowed, because they're foreigners and the tax situation. They're just basically, by design, they're not allowed to invest in funds. And then now we have a property in Atlanta under contract that we're about to close in about 3 weeks or 4 weeks.
So what's your experience?
The reason. So I was going to tell you why it's a good time to be buying right now. So in 2022, when we bought the Birmingham property, we ended up looking at 800 and so properties to buy one property. 2023 came and the rates started going haywire. Okay. And then prices started coming down. And one of the issues that we saw that did not allow us to buy properties is because we always underwrite to about a 7% cash on cash net to an investor, right? And about 14 to 15% IRR net to an investor. But all that is throttled by your replacement cost, your price per pound. So what was happening in 2021, right, in early 22, was that people were buying great cash yields, low cap rates at high acquisition cost.
Mm-hmm.
So if you look at underwriting on a 2021, let's say late 2021 property, yes, the exit cap rate is about a 4.5 or whatever it is, but the price per pound was like $350,000. I'm like, why will you sell at $350,000 5 years from now or 3 years from now a property you can build for $250,000, right? So it didn't make sense. And so my point is that there is this intrinsic sort of self-sustaining, self-correcting thing about residential real estate, okay? Which it tells you what the correct price for things are based on what people pay for rent. And that rent has been proven over time that it's always above inflation, and it's very steady, it's very resilient. It's not that volatile, contrary to what people think, especially if you go to a workforce theory, which is, you know, if you're doing like workforce rents, you know, $1,500, not many people can build a building today that can sustain those rents.
Right.
Mm-hmm.
So you're going to have a supply-demand imbalance at some point.
What have you seen in terms of, so what's your experience been over the past 5 years in terms of expenses versus pro forma, rents versus pro forma, as inflation has, you know, as things have gotten a little bit weaker over the past year or two, have you seen any nominal rent decreases? And how is that experience then informed the way that you're thinking about your underwriting for properties that you're looking at today?
It's a good question. Although we're very, very, very conservative, we always get hammered somewhere. So there's two things that you cannot, you know, really think about, which is, you know, what's the cost of insurance is going to be in 3 years from now.
Mm-hmm.
Insurance has been crazy. It's been brutal.
Right? So take away insurance. If you take away insurance, then you're basically left with, you know, how much my rent is going to grow, because that gives you the top line, right? And what are my expenses going to be in the bottom line? Okay? And I think those two complement each other. And let me explain why. Take away insurance and taxes, okay? And now you're left with property management, which is a percentage of income, okay? You're left with maintenance, which is basically a human factor, okay? And then, you know, bad debt and all those things. But at the end, that is forecastable, okay? You more or less know what the maintenance is going to be in a 2005 building and a 1983 building. The hardest thing that we have faced is the human element. So the properties were underperforming is because we had a human element that didn't work well. Meaning, for example, in one of our properties, when we took it over, the property manager had cancer, and I mean, they're going to treatment, this, and that. You don't fire somebody who has cancer. You just don't go like, oh, sorry, you know what, right? And so even though we have really good property management companies, because we hire the best and the brightest in every market, we don't like property management. We did it. We know how to do it very well. And so we took those experiences and we parlayed them into being really good asset managers.
Mm-hmm.
So if you take the best property manager in the world, if you're not on top of them, they're going to screw it up, right? Yeah. They're basically going to go hire the most expensive person that they have in their roster.
Yeah, it makes it easier. It makes it easy for them, right? Like, you know, like they get the high service level, right, from the expensive labor.
And the local property manager doesn't want to have a vacancy, and so for them, they're not going to go push somebody in apartment 305 to either, you know, increase their rent for $200 or leave, because that creates more jobs for them, right? I mean, a property manager wants to have a property 100% full and don't have to worry about it. Mm-hmm. A property that's 100% full
means you're not pushing rents enough. Yeah,
it's badly managed.
Yeah.
Okay. And so the question is very valid, Jack. Everybody talks about the underwriting part of the property, but I think that the most important thing that you have to underwrite when you're looking at an investment, you have to underwrite the team that will asset manage that property. And that's where we actually excel, because we have so much experience, like you guys. Like, I've done evictions myself. I've unclogged toilets myself. I've been on top. Like, we've done it, right? So when somebody calls you up and said, oh, you know what, we're going to change this toilet and it's going to cost you $250, you go like, BS. Go to Home Depot, buy it, get a wax ring, and, you know, it's $30 later, 30 minutes later, you can change it, right? And so we know the prices of those things. We know how to push rents, how to deal with operations. And so that asset management aspect, it's key. And we're learning. We're learning. Every time we buy a property, something new comes up, and we're learning. We don't have the advantage of having a platform with 20 years worth of experience in large multifamily. But I will say that one of the smartest things that we did is when we pivoted from our small multifamily sort of single family portfolio, we realized that although we had the great expertise of dealing with highly complex operational situations in single family and small multifamily, we didn't have the expertise of a large multifamily operation. And so we brought into our platform people who, what I call it, no hair or gray hair, people who had been there for 30, 40 years, who have been through the cycles, sure, who understand and know what to do.
That dyed-in-the-wool multifamily guy.
Yes, right. Correct. And so, yes, there is a lot of risks that come from the operational side. Now, let's talk about the rent side. Rents behave extremely well with inflation for a simple reason. What does inflation mean? Inflation means that, things in the past now are worth more, which means a brick is worth more now than it was worth before, which means construction is worth more now than it was worth before. So rent has to go in order to sustain the value of that brick. Otherwise, nobody's going to build anything. Mm-hmm. Okay. And so rents went really up when COVID came because of what you said. And people started getting the check and they say, mother, I'm going to leave my basement and I'm going to go rent an apartment because I got a free check from the government. And then they stopped getting the free check from the government. But also what happened in COVID, the rates were very, very cheap. And people started building with money that was very, very cheap. And because rates were very cheap, you had all these doctors and dentists and, people just throwing money at syndicators who had no idea what to do with it. Mm-hmm. Right? And they just syndicated things and put money in here and there. And now you see a lot of people losing money in multifamily deals, not because it was a bad asset class, it's because they bet on the wrong operator, on the wrong structure. People took risks. All the syndicators that you see now hitting, the wall, it's because they structure with extremely high leverage, a lot of financial engineering, trying to sort of, take as much milk from the cow today, and then the cow eventually died. Okay, so I do believe that the asset class is extremely resilient, and well managed. It can sustain anything.
Have you seen like a building that you were looking at in 2021? Is it available now? Is that building available now for a cheaper price?
20%
nominal price.
20% less. Yes.
20% less from a price per pound point of view.
Yeah, and right now is the best time to buy. Why? Everybody's on the sidelines waiting for interest rates to drop.
Yeah.
So what do you think it's going to happen? I mean, there's billions, in the sidelines waiting for interest rate to drop.
Doesn't it feel like too, Jack, comment as well, doesn't it feel like too that people are still waiting for the knife to drop as well? I don't know that the average investor knows that multifamily is 20% less in some markets. I don't hear that. Jack, were you familiar with that? That multifamily? Go ahead.
Yeah, I thought it was down. The 20% makes a lot of sense though, right? Like it's down enough that the equity's not wiped out. The syndicator's still going to work every day. You just, they've lost money on paper, but no one's actually been forced to recognize it. And then as long as the lender doesn't want to put a gun, take you out to the back, and shoot you in the back of the head, you just continue to operate,
Sure.
Well, Jack, the easiest way to get to that, I believe that's the equilibrium point, and the easiest way is that sort of the returns that are requested by investors in the market are sort of still the same, like 7 and a 14, right? So now that interest rates are higher and you need to solve for that 7 and a 14, right? Instead of getting 80% loan to value, now you're getting 60% loan to value, that the 20% has to come from something, which is the price drop.
Yeah.
Okay. And again, the issue that we were having 2 years ago is that when you were solving for the exit price, the price per pound was so high that it didn't make any sense. Might as well build it now and deliver in the future for that price.
Why do you think prices aren't going to continue to slide? If interest rates stay up for longer, rents aren't really increasing, and we may, maybe going into a more, boring or, maybe small recession market? Like, why don't you think that the knife is going to fall further?
A couple of things. One, first of all, it should fall further in certain places and in certain specific buildings that were badly financed. So yes, you will see somebody who bought something for 100, and I'm talking multifamily real estate class B, right? In good places. I'm not talking the office building that, it's 100 sold for 20. Okay? Because rents have not fallen nominally. A little bit. They went very high up and then they started to come down because of deliveries.
Yeah.
So all those deliveries are going to burn down in 2025 or 26.
Yeah.
Because high rates and high cost, nobody's building anything. But just think about the following. Rates are so high, people cannot buy a home, which means they rent.
Right. Yeah.
Right? Rates are so high because there's inflation, because people are getting more salary. So I call bullshit on this whole thing that people don't have money to pay to, buy a home. Okay? Because if you look at, the rates, historical rates, 6 and 7% mortgages were kind of the norm. What happens is these days is people, I think, don't have the necessary discipline to save for that. I mean, you have the phone and the coffee and this and that. And the other thing, and again, I think the American dream of that you can buy anything with with a 40-day, 40-hour work week, it's gone. Like now you really have to work 60 hours, right, in order to sort of be able to afford things. And so this whole concept of I'm gonna go work 40 hours, pay $10 for avocado toast and $3 for a coffee, right? And my lunch hour gonna go to Chili's for $20 lunch. You have to save somewhere.
Yeah.
Right?
You're really laying down some hard law right now.
Yeah, before you were getting people paid $8 at McDonald's, now everything's starting at 15. So they have 100% increase, and people still don't want to work, which means that they have better things to do with their time or their money. So I think that when people like, oh, the rent went up by 10% in a year, yes, that's $150 and a $1,500 rent. It's a shitload of money, right? But it's 3 hours or 4 hours or 5 hours, 10 hours worth of work in a month. So I think it's still affordable. The most important thing that I think it is, and this is what I call the elephant in the house, not in the room, is that everybody thinks that properties are not being built because of interest rates and the cost. It's the government, right? And the government basically is not allowing things to happen because of cost of doing business in the local cities, because of, the regulation, the land, the time it takes. So it doesn't jive, right? If the government, I think, wants to solve this issue, it needs to take a top-down approach, and the federal government has to say, you know what, this is what we think it needs to happen in every county and state, where you have to facilitate the building of, workforce and affordable housing.
So what are you seeing on the seller side of things then? Like in the market, as you guys are making offers, are you finding that the bid ask spread has tightened and deals are starting to happen again at these prices that are 20% lower? And who are those sellers, right? Like, is it the busted syndicator? Is it just the old guy, the fund that's shutting down?
Fund shutting down, some syndicators, we're starting to see some really interesting opportunities on, how do you call it? Developments that are in stabilization, and so the developer that had cost basis that they started in 2021, and it's a good cost basis, right? Now says, you know what, I need to cycle out my money, okay? But equally important, I think that, sellers just basically realize that if you want to sell, it has to be in this market. Not a lot of people can afford to have a property operating with double the insurance and double the interest rates. Having said that, everybody's waiting for blood in the street. I don't think there'll be blood in the street.
Are you seeing any lender restructurings? And
yeah, sure, but again, remember that the reason we were able to buy things in 2009, 10, 11 is because there was no financing.
Right.
Everybody was just scared, and all the investors didn't want to put money in.
Went to a cash number. Had to be a decent unlevered return.
Exactly.
Now you have rescue capital, all the types of rescue capitals you want. You have preferred equity. the banks are solid. They can rework on it. They can sell it. I mean, there's so much money on the sidelines waiting for it. When we were buying houses here in 2008, you buy a house, the bank will call you and says, I have 10 more. You want to buy them?
Right.
So that doesn't happen right now. Sort of the inventory, I think it's under control, right? And so if there will be blood in the street, it will be in a specific deals that are, really badly structured, or people who thought that they can, tame the beast in a Class D property and convert it into a Class B, and they didn't know what they were doing. And so, some of those things will probably be trading badly. My experience is we didn't buy from the court. We bought in the REO world when we were buying single families, because we had the pick of the crop. We can go see it and the whole thing. So there's funds who's like, we will only buy if it's totally distressed. And they're just waiting on the sidelines. In the meantime, we're having conversations with all the brokers that are bringing us deals. And sometimes, it makes sense. Like this deal that we are buying in Atlanta, in McDonough, we're assuming that at 3.5% 6-year fixed.
Yeah, that's a nice feature
so
right now.
We are coming in. We're coming in at day one cash on cash of about 7%.
Mm-hmm.
In a deal that we're buying at $191,000 per unit, townhomes, in McDonough, which has 56 million square foot of warehouse, which is a solid city outside of Atlanta MSA.
Mm-hmm.
But how did we get there? Because we underwrote 550 deals in a year, right? And we're people who are known in the industry for, doing what we say we're going to do. So we're not posers or anything like that. We don't want things and put in retrade. And, we've always closed in our deals. Like, I've always, we never sort of retraded. Even when we were buying single family houses, we never retraded. Right. And so you have to build a pipeline and a reputation, and obviously the capital stack in the back with the fund in order to be able to acquire it. But I do believe that right now it's the time to buy, because, again, acquisition price, cost basis is permanent.
Mm-hmm.
Financing is temporary. Okay. So now we're buying a price per pound that it's much lower. And so I believe that that's where, if you have very good money, you should be looking at multifamily, because I think it's resilient and it's going to be there for the next 10 years.
Jack, we have a couple minutes left in this episode, and one of the questions that I fail to ask on most of the smart guys that are on the show is, what if you were wrong? And I love your forward thinking, Danny, and I'd love to talk in the next episode, if we could have, what if we're wrong? What if there's another black swan event like the GFC or COVID? I
love that. I love that question, because it reminds me of my wife. What if you're wrong?
Yeah, exactly. Right? I probably got the same from mine. But
Jack was recently married. He's just starting to laugh about that one. Before he didn't get it. But anyway,
no. Okay. So let's end this episode here, and we'll come back with Danny Kattan of PIA Investment Group and Southern.
Let's assume that we're wrong.
Yeah.
GFC, shit hits the fan.
Right.
Everything goes south.
Jack knows I love these kinds of conversations. Right. So
what happens with your money in the bank?
Yeah. All right.
What happens with the money in your stock account? What happened with the other asset class?
Sure.
I go back to the same thing, and I wrote.
Don't give it away. This is a big tease for the next episode here. We're going to end this one here. This is Real Investor Radio with Jack Bevere and our great guest, Danny Kattan. I hope you guys have enjoyed this one. Stay tuned for the next one. We'll be right back.